Welcome to our global market forecast, brought to you by Options 21, with a special focus on Texas light crude. As per last week's presentation, let's just review global indices to start with, and then we'll tackle oil last of all. 2 weeks ago, we suggested that there's a high probability that the market would start a pullback, and the reasons or the fundamental reasons for the pullback were unknown at that point in time. It was just the beginning of a technical pullback. We now know that the discussions between China and the United States is what's driven this 4 to 5% pullback. But pullbacks are just that. They're just a pullback in the market. They're not a corrective phase. They're just a point where negative fundamentals are absorbed into the market and the market sells off. Then it bases out, then it starts to track to the upside as the fundamentals dissipate in their effect on the market, and negative news dissipates. It halves in its effect by every 24-hour cycle. So we're now down the track many days. First of all, Trump suggesting or saying that he was going to raise tariffs with China. They occurred, and then the Chinese retaliated. All the negative news is now within the market. So the reason for the pullback is complete, for want of a better word. There is no other further negative news unless there's something that comes out of left field. That's it in terms of the pullback, in terms of a fundamental driver. So what we've got to do now is focus in on what's happening in the present, not what could happen in the future. It is within the interests of both the two biggest interdependent economies on the planet to finally come to an agreement. So this shouldn't evolve into a major, disagreement, but it should, on most likelihood, just evolve into a strong negotiation, which will be solved in time. It's probably going to take a lot longer than people realise, but in that time they'll have their disagreements, they'll pull away from each other, and it'll create market volatility. But my point is, we now should be focusing in on what's happening in the present. What's happening in the present is the market has come back to a point where it's starting to do 2 to 3 bars, and the bars are side by side. The bar yesterday is engulfed. It's engulfed the previous day's bar, and that higher range, or that big range, is quite bullish. Does that mean that's it? No, it doesn't mean that's it. There's every chance that the market could go down again, do another little retest, but every time you see one of these bars going side by side, either inside or outside days, it is telling you that we're coming close to a resolution of what is probably the beginning of the low in this market. If we just place a trend line on the screen, I did note that the market did break below that trend line. I think I may have put up that trend line last week. That was of some concern, but in addition to looking at trend lines, it's not the only thing that we may look at. We were also looking at the pullback in relation to the division of Fibonacci's within the previous range of the market, and that had us on the basis of the previous range pulling back 0.618. Now, 0.618, technically speaking, is significant, and it is definitely a significant pullback. And if the market continued below 0.618, there's a problem. There could be a potential change in trend. And then if the market continued and evolved and broke a previous swing lows, that's when we've got a problem. But that's not the case at the moment. At this point in time, the market's had a relatively, a 4 to 5% pullback, come back to 0.618. Looks like it's stabilizing. And there is some evidence that that probably is it. And the evidence usually comes from advancing and declining stocks and their volume performance. On inspection of the numbers last night, the volume in terms of advancing and declining stocks has changed. In the last week, we had 220 advancing stocks, 254 declining. I'm talking S&P 500 advancing and declining numbers. This week, we've got a switch. We've got a higher advancing number. It's 233 advancing, 239 declining. I've stressed most importantly that the volume of advancing and declining is very important, not just the raw number. So last week, the declining stocks had a volume percentage, which was 24% above advancing. This week it's 23% above, slightly declined. But this is the point where you see a switch. The advancing and declining are the internal numbers, which tell me they're a little bit preemptive. They're not perfect, but they're quite preemptive of a switch in the market. And I said exactly the same thing at that top. When we were at that top, I was suggesting that it's time for a pullback. It was actually based on the same numbers. So here we have the switch. It hasn't completed, but it looks like it's starting. So next week when I do this presentation, I wouldn't be surprised that the confirmation of advancing and declining is in, we've built a low, and we start to break to the upside. We haven't got actually a technical low on this pullback just yet. It needs to break up, break trend, form a pattern, none of which has occurred, but I believe we're probably very close to that happening. Mid-cap stocks represented by the IWM, Russell 2000, is often a lead. It often leads the broader market, the S&P 500. The lower capitalized stocks tend to be more volatile, and often, as I said, I made this observation, they can lead. In this case, they're not. I'm just putting it up out of interest. This market put in a big accumulation phase and actually is still within this accumulation phase with the market tracking sideways. That track sideways is actually called a time correction. Time corrections generally are bullish, so I wouldn't be surprised if we saw a very strong move out of this area, especially if China and the United States come closer to an agreement. Jumping across to the Canadian market, we can see, the accumulation phase marked up in blue, but I'm more interested in the pullback and the depth of the pullback at the present time. And in the Canadian market, it's a 0.5 pullback, and I could draw a trend line on screen, which I'll do for you. And it has moved below its trend line, just like it has done in the S&P 500, but it's settled on a Fibonacci ratio. Once again, Fibonacci ratios are not magical. They're just lines of support or resistance, which you start to look for the evolution of accumulation. Has accumulation on this pullback occurred just yet? No, it hasn't. By any sense of a definition, it's just a line on a screen at this point in time. The interesting thing with Fibonacci ratios, if it starts to pull back deeper than 0.618, it signals a concern of which we don't have just yet. Jumping across to European markets using EWG, the Exchange Traded Fund, traded on nicely representing the DAX. We can see that it is broadly maintaining its trend line. The pullback that we can see on screen is looking like about a 0.618. If I put up the Fibonacci ratio, it's exactly 0.618. Once again, this is okay, but you wouldn't want to see it track to, start to trade again into next week below the trend line, below 0.618. That would be a big warning signal that the market's potentially breaking trend, but that's not what we're seeing on screen. What we're seeing on screen is absolutely fine, and that would be true whether we look at the DAX from the Exchange Traded Fund, which has a currency effect, or we look at the DAX direct. It looks the same thing. It's just the DAX, the actual DAX, has done a 0.5 pullback. It's sitting above the trend line. Absolutely, completely and utterly normal. Markets don't go straight up. They have rallies, which are called extensions. They have pullbacks. They distribute at the top. Then they have their pullback. Then they start to accumulate and they move to the upside. So again, absolutely nothing unusual about this chart. It's all looking good. Jumping across to EWU, which is the United Kingdom. Unusually, it has also, well, not unusually, it has had a pullback. It has broken trend, but again, based on previous ranges, sits on a 0.618 pullback, division of Fibonacci range. Nothing of great concern other than if it keeps on going, I'll be saying something different next time we speak. Let's move across to Asia Pacific, looking at FXI, which is top capitalized stocks built into a exchange traded fund traded on NYSE. And we can see the effect of the discussions between the United States and China has had a dramatic effect on the Chinese chart. This is FXI. It's had an extremely deep pullback. Obviously, it's done a break of trend, but I do note that break of trend resides on a 0.618 pullback and it's bounced. This is the point which you'd expect it to find a level of support and start to track back to the upside. If I jump across to the actual Shanghai composite chart, from the accumulation phase, a really large rally based on the belief, the global belief of finance markets, were of the view that the situation in tariff discussions was quite well advanced and they were very close to an agreement, not very close, but they were reaching or getting more closer and closer to an agreement, which is obviously not true now. This market has had a massive reaction to recent events in the last week and also has done a significant break of trend and pullback, but that pullback is only 0.5. That's fine. The worry here would be if it starts to pull back deeper than 0.618, then we've got a broader, something different is occurring in this market that we would have to watch very carefully. Staying with Asia Pacific, jumping across to the Australian charts. First of all, using EWA, the Exchange Traded Fund representing Australia. This market is having a pullback, but it's also in a time correction. This is quite bullish. If the market breaks up from here, if it did it now, it'd be a higher low, which is absolutely fine. Using the ASX 200 chart, which is the local Australian chart, and opening up the screen to just get a little bit more information, we know the market's been trending up. We know the market's been pulling back. The significance is, where's the pullback? The pullback is on the 0.618 and then it bounced. If I break this chart down into a 60-minute chart, let me do that. Markets are fractal. There's information available. What you'll see on this chart is a chart that's put in what it'd be. I could only describe as it's in the throes of putting in an inverted head and shoulders pattern. So what should happen here is the market should continue to rally, put in some form of right shoulder, break trend and continue up. If that does not occur, okay, that's the logic. If it doesn't occur, something else is happening. It's usually the reverse. If the market collapsed from here, broke the lows of the 13th of the month, we've got a problem. But at the moment, it's a bullish unfolding pattern supported by good volume, and it should continue to the upside until proven wrong. Okay, last of all, we're going to have a look at Texas Light Crude. The Exchange Traded Fund representing Texas Light Crude is USO, United States Oil Fund, and it's obviously has been in a strong uptrend and continues to be in a strong uptrend. Yes, we can see the market has pulled back. It's pulled back to 0.618 of its previous range, which is a deep pullback, but that's where the market should stop. There's significance in the number of days that are going sideways, which is usually the evolution of accumulation. If the market finishes its accumulation here, it breaks the upside, it's maintained a series of higher highs and higher lows, which is a maintenance of the upward trend. And I would suggest that that pullback has been quite shallow, which talks towards an acceleration of trend. Now, for it to accelerate in trend, we need probable fundamentals to support that. And there are a few global fundamentals that could support a continuation of an upward move in crude oil markets globally, and it's the evolving situation with Iran. There appears to be, a lot of chatter on the internet. Go listen to stories that talk about, just there's no conflict, but just a ratcheting up and a bit of saber rattling, and a few issues happening in the Middle East in the past week, which would be the stimulus or the trigger to push crude oils strongly to the upside. That said, irrespective of the triggers, it is a long contract. It's long. It's up. The trend is strong. I do have volume information backing USO, and I track buying and selling volume, and the selling volume has been there, but it's getting significantly lesser than it was last week, which indicates a turn. So as this market evolves and tracks sideways, it's building accumulation phase, getting ready for its next move to the upside. And when we're here next week, not that I'll be talking about oil, but we should see this continuous trend, and that's an ongoing opportunity and obviously should be a part of your portfolio. There is another contract called XLE, which is a broader measure of energy contracts, which you could also watch. It's not a specific oil contract, but it's the complete energy complex, which includes oil, natural gas, companies like Halliburton, which support, support energy companies, and many different areas of energy into one, represented by one exchange traded fund for those who are interested in tracking energies. That's it for today. If you ever want to talk to me, you may do so direct. My email is paul@options21.com.au. That's paul@options21.com.au. Happy to get your emails and answer your questions direct. Thank you.